If you're raising a cross-border fund, chances are someone has already told you, just use Cayman. And they're not wrong. The Cayman Islands is still the most recognized fund domicile in the world. Decades of case law, a mature regulator, and a deep bench of service providers. But here's the thing LPs won't say out loud. Cayman isn't a free pass anymore. In 2026, institutional investors are drawing a sharp line between Cayman funds that just check compliance boxes and Cayman funds that actually govern like they mean it. This is part 2 of a 6-part series on fund domiciles and what LPs really see when they look at your jurisdiction. Today we're breaking down the Cayman Islands, the global default, the perception challenges, and what it takes to stand out. Let's get into it. I'm Corey, a lawyer helping entrepreneurs decode law, technology, and innovation. In today's video, we're continuing our series on how LPs interpret fund domiciles and why your jurisdiction choice matters more than ever in 2026. So here's what we're covering today. First, why Cayman became the global default for cross-border funds. Then, what LPs actually see when they see Cayman and the perception challenge you need to understand. And finally, how to use Cayman the right way so your fund stands out instead of blending in. Why Cayman became the global default. Let's start with some context. The Cayman Islands has been the dominant fund domicile for decades, and there are real reasons for that. First, legal infrastructure. Cayman has deep case law on fund structures, LP rights, and GP duties. When disputes arise, there's precedent. That predictability matters to LPs and their lawyers. Secondly, regulatory maturity. The Cayman Islands Monetary Authority, or CIMA, has been regulating funds for a long time. The Private Funds Act, updated in recent years, sets clear requirements for audit, valuation, and asset segregation. Third, the service provider ecosystem. Cayman has a massive concentration of fund administrators, auditors, legal counsel, and directors who specialize in this space. You're not building infrastructure from scratch, it already exists. And fourth, global familiarity. LPs around the world know Cayman, and it's common language for cross-border private funds. When you say Cayman fund, everyone knows what you mean. So yes, Cayman earned its status as the default, but the status comes with a catch. Now let's talk about it from an LP perspective. When LPs see Cayman on your fund documents, their first reaction is usually neutral, it's expected, it's familiar, and it doesn't raise any red flags. But here's what changed in 2026. Neutral isn't enough. LPs are now asking a follow-up question, sometimes out loud, but sometimes just in their heads. Okay, it's Cayman, but how is the fund actually governed? You see, Cayman's flexibility is a double-edged sword. The jurisdiction allows for a wide range of governance setups. Some funds operate with full institutional rigor, others do the bare minimum. LPs have seen both, and they've learned to look deeper. So when they're reviewing your Cayman fund, they're looking for signals. Do you have independent directors? Are your financials audited by a reputable firm? Is your valuation policy documented and followed? Are your side letter terms consistent and fair? If those signals are strong, Cayman works great. If they're weak or missing, LPs start to wonder what else might be thin. Okay, next, let me be direct about something I call the governance trap. Because Cayman is so common, some managers assume it does the credibility work for them. They think, we're in Cayman, we're compliant with CIMA, we're good to go. But compliance and governance are not the same thing. Compliance means meeting the minimum legal requirements. Governance means how you actually run the fund, how you make decisions, how you manage conflicts, how you communicate with LPs and protect their interests. LPs, especially institutional ones, care deeply about governance. They've been burned by funds that were technically compliant but practically problematic. So here's the trap. If you treat Cayman as a shortcut to credibility, you're actually signaling the opposite. You're telling LPs that you're doing the minimum. The funds that stand out in Cayman are the ones that govern like Delaware. They adopt best practices not because CIMA requires it, but because it's the right way to run money. So how do you use Cayman in the right way in 2026? Here's my playbook. First, appoint independent directors who actually engage, not just names on paper. LPs want to know there's real oversight at the board level. Second, use a reputable auditor and stick to a clear valuation policy, document it, follow it, and be ready to explain it during due diligence. Third, align your LPA with institutional standards. Model it after Delaware norms, include clear terms on fees, conflicts, reporting, and LP rights. Fourth, over-communicate. Send quarterly updates. Be transparent about performance, challenges, and changes. LPs remember funds that keep them informed, and they remember funds that go quiet. Fifth, treat side letters carefully. If every LP has a different deal, it creates complexity and potential conflicts. Aim for consistency where you can. Do these things, and Cayman becomes a strength. Skip them, and Cayman becomes a question mark. Okay, so let me give you a quick framework for when Cayman is the right choice. First, you're raising a global LP base. US investors, European institutions, Asia-based family offices. Cayman speaks to them all. It's the common ground. Second, if you want flexibility in fund design, Cayman accommodates a wide range of strategies, structures, and investor types without heavy regulatory friction. Third, if you need a mature service provider ecosystem, if you want plug-and-play infrastructure such as admin, audit, legal, directors, Cayman has it all. Fourth, if you're willing to invest in governance, this is the key. Cayman works best for managers who see governance as a competitive advantage, not a cost center. If you're raising cross-border capital and you're serious about raising a professional operation, Cayman is still a strong choice. Just don't expect the jurisdiction to do the work for you. Okay, so let's bring it all together. Cayman is still the global default for cross-border funds, and for good reason. The legal infrastructure, regulatory maturity, and service provider ecosystem are unmatched. But in 2026, LPs are looking past the domicile and asking, how is the fund actually governed? The funds that win are the ones that treat Cayman as a foundation, not a finish line. Independent directors, audited financials, documented policies, transparent communication. Cayman can't mean light touch anymore. It has to mean professionally governed. Your structure will speak before you do, so make sure it's saying the right thing. Okay, folks, so that's part 2. Done. In part 3, we're heading to the British Virgin Islands, or BVI for short. I'll break down why BVI still has a place in the fund world, what LPs actually think about it, and when it makes sense for emerging managers and niche strategies. Make sure you're subscribed and hit that notification bell so you don't miss it. Join me on the path to decoding law, technology, and innovation to grow your business. Don't forget to like, share, subscribe, hit that notification bell. Until next time.